Hello, thank you for tuning in to Legacy Private Trust Company's February Fed Decision Rapid Reaction. My name is Peter Schaefer, Trust Investment Officer, Legacy Private Trust, and I'm joined by my colleague and fellow investment officer, Connor O'Brien. Yesterday, we just had a Fed decision that moved the markets, and we'll talk about that in just a little bit. But what we wanted to do is talk a little bit about what decision happened yesterday, what happened with the markets, what portfolio changes we may or may not be thinking about, and also what else we're paying attention to right now. So I think we should just jump right in. Connor, we had a Fed decision yesterday. What happened? And I guess more importantly, was it expected?
Yeah, PJ. So we got a 25 basis point bump in the Fed funds rate up to 4.5 to 4.75%. There was really no surprise there. That was very well telegraphed by the Fed and by the markets. The markets had essentially fully expected a 25 basis point increase in Fed funds for pretty much a full 2.5 months, really going back to the soft CPI report in December. So there were zero surprises when it came to that move. There were a few minor revisions to the FOMC statement. So specifically, they swapped out the word pace for the word extent when referring to future increases in the Fed funds rate. The implication there is that, it's no longer a question of how quickly will they raise rates. We're not going back to 50 basis point, 75 basis point increases. The focus now becomes, how long does this need to go on? Is it another month, another 2 months, or potentially longer? The other revision that was made that is potentially a bit more important was an acknowledgement in the statement that inflation has eased. You can see it in green there. Now, inflation has been easing, really since early fall. The Fed has intentionally chosen to ignore that in FOMC meetings, ignore that in speeches, and ignore that in really any statement they've put out. The reason being, they didn't want financial conditions to loosen too much. They didn't want rates to fall too much. So for the first time in their official statement, they did acknowledge that inflation has eased somewhat. But overall, not a huge change to the message. They still noted that future increases will be appropriate. They still noted that the committee is strongly committed to returning inflation to its 2% objective.
Okay, so let's just back up for a second. So Connor, you said that the 25 basis point move was widely expected, priced in since December. Yesterday, the market was pretty much flat going into the decision. Afterwards, the S&P 500 finished up over 1%, tech-heavy NASDAQ up over 2%. Why'd the markets move the way they did if everything was pretty much as expected?
Well, and it's up again today as well. I think the NASDAQ's up about 3% today. So as I mentioned, nothing was unexpected in the actual change to the Fed funds rate or in the statement. However, the press conference that Jay Powell gave after the statement was a whole nother story. Remember, there are really two parts to this process. There's the Fed press conference in which he gives prepared remarks, and then there's a Q&A session from the press. The prepared remarks largely matched the tone of the FOMC statement. Restrictive stance, ongoing increases, substantially more evidence that they need inflation to come down, blah, blah, blah. However, there was a notable shift in tone when you look at the Q&A session. And when you look at when the markets really started ripping yesterday, it was in direct response to a few of Powell's responses in that Q&A session. Prior to yesterday, every time Powell had an opportunity to be hawkish over the last really year, he's taken it. Every time he's had a chance to tighten financial conditions, he's taken it. Not only did Powell, but all of the Fed members, they've pushed back on lower rates. And it's really been, what's been considered unconditional hawkishness no matter what. Yesterday was different. For the first time, Powell acknowledged that he thinks there's a path to a soft landing. He didn't push back against easing financial conditions, and he did acknowledge that we might not need job losses or a mild recession to get the inflation rate back to 2%. He's really looking at data over the past few months. Inflation has come down from 9% plus to 6.5%. We just had GDP for the fourth quarter. It came in at close to 3%. And you still have unemployment down at about 3.5% at the lowest level it's been in 50 years. Just really, really strong economic data and decelerating inflation. And he's looking at that and saying, there's no reason that at this point we can't pull this off. Now, Probably his most important response was when he was asked about whether or not the Fed could consider cutting rates this year. As we saw on the last slide, there's a huge discrepancy between what the Fed says they're going to do and what the market thinks the Fed's going to do. And when asked about whether Fed rate cuts would be possible, he gave an answer that said, while he doesn't think that they will be appropriate, if inflation comes down faster than expected, it will be incorporated into our thinking about policy. That was the statement that really pushed stocks higher and bonds lower. The acknowledgement that the Fed will be data dependent and won't just unconditionally raise rates and keep rates high no matter what happens. After that, stocks hit their highest level in 5 months. Bonds, ripped as well, and financial conditions eased to their lowest level in 5 months as well.
All right, so we talk about how the inflation's coming down, that impacts interest rates. We don't need to rehash 2022. We all know that that was very difficult for stocks and bonds because interest rates shot through the roof. Now that things are changing and we see that interest rates are coming down, both stocks and bonds have done quite well this year. Has that changed anything with our portfolios? Have we made any adjustments to that?
Yeah, so in our eyes, the window of opportunity to take advantage of high yields is shrinking. We think that a 4% plus yield to maturity in a bond portfolio is a gift, and we are trying to take advantage of that. If you think about it, whether or not we get a soft landing or whether we get a recession, mild or deep, in both of those scenarios, yields drop. So in January, we took advantage of the big leg higher in the equity markets to move 5% of our portfolios out of equities and into fixed income to capture or take advantage of that higher yield to maturity fixed income portfolio while it's still around, right? That brought our portfolios back to a neutral allocation between stocks and bonds.
Perfect. So kind of we spent the majority of this call talking about the Federal Reserve and interest rates. And frankly, I think that's probably where we should be because that's the biggest impact to the markets. But is there anything else right now that's going on that we as portfolio managers are paying attention to?
Yeah, so we're right in the thick of earnings season. We had Meta last night. You have Apple, Amazon, and Alphabet all after the bell today. If you're looking for a source of potential market weakness, this is an obvious place to start. Analysts have really started revising earnings expectations lower, and you can see that in the chart here. There was some irrational exuberance when it came to earnings expectations. Analysts took the 50% earnings growth that we got in 2021 and extrapolated that a bit too aggressively into 2022 and 2023. We very likely could get negative earnings growth for the first time since COVID this upcoming year. Now, keep in mind when you hear about earnings growth rolling over or earnings growth going negative, it's important to put that in perspective and look at just how well companies continue to operate, especially in comparison to pre-COVID.
And I think too that makes the case for why we took a little bit out of stocks and put that into bonds, right? We had a terrific first start for equities. We said, hey, let's ring the register a little bit and put that in bonds. And I think earnings is a good reason why we wanted to maybe get a little bit more defensive. So lastly, Connor, the sort of back to the Fed, right? Our next big Fed meeting release date is going to be March 22nd. Anything on the calendar that could move the markets maybe one way or the other that we want to pay attention to?
Yeah, we'll get some really important economic data points between now and March 22nd. First and foremost, we get 2 jobs reports. One comes tomorrow, and one is on March 10th. So we'll not only look at payrolls and job creation, but we'll also look at average hourly earnings, right? The Fed really wants to see average hourly earnings continue to tick down and roll over. We really only get one Fed speech between now and March. Some more may get added, but the only one that's on the docket right now is for next week. We'll get John Williams, who is the president of the New York Fed, talking at a CFO summit for the Wall Street Journal. We also get 2 CPI reports on the 14th of February and the 14th of March. We'll get 2 PPI reports on the 16th of February and the 15th of March, and then we get PCE on February 24th. So just a ton of new data for the markets to chew on, for the Fed to chew on. And this is really the main reason, I think, why the market thinks that March will likely be the last Fed rate hike. We could possibly be looking at a CPI print in the low 5s as early as March 14th. or even lower. That's from 6.5% today, remember, and 9% plus a few months back. And if that's the case, the market will likely be right about one more rate hike. If we get some frothier CPI prints this month and next, then you'll likely see markets adjust higher and price in a final rate hike at the early May meeting.
Only time will tell, right? We have a really interesting next 30, 60 days with Fed meetings and interest rate and inflation data coming in. So first off, thank you, Connor, for joining us here today as we sort of do this Fed rapid reaction. If you're a legacy client, you have questions, please don't hesitate to reach out to your current legacy advisor. If you're not a legacy client and just have more information about our firm and what we do, please feel free to reach out to us at info@lptrust.com. Thanks for joining us.